Hey everybody, it's Erik, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today joined by two very special guests, Marcos Veremis, Managing Director of Investments at Evanston, an institutional investment firm based in Chicago, and David Fauchier, CEO of Cambrial Capital, an investment firm out of London focused on crypto funds. David, Marcos, welcome to the podcast.
Thanks for having us.
Thank you, Erik.
Let's start by way of introductions.
So I've been researching and investing in this space for the past eight or so years, since late 2012, early 13. I did originally a master's in history and did a lot of economic history. And then after that, I was working in tech, and someone sent me the Bitcoin white paper, and it was this sort of wonderful kind of intellectual thing to kind of work on and think about. And I just kept noodling on it. And after about 6 months, started to realize that these crypto networks, and Bitcoin was really the only one at the time, were kind of enabling coordination at scale in a way that didn't exist before. And that you shouldn't really think of these as digital currencies, but as, at least for me, generalizable mechanisms for coordinating work at massive scale. And there's a lot to unpack in that, but the essence is that it kind of clicked for me that crypto as a whole was going to be this big kind of enabling technology over the next couple of decades, and potentially would offer solutions for a lot of the problems that we knew we had with the internet and still have. And so it's everything sort of went from there. And Cambrial is about 2.5 years old.
Awesome. And Marcos, how about you?
Yeah, so I'll start by saying that I happen to be Greek, so that played a role in my interest in crypto. I followed the European crisis, very closely. I've been living here in the States and in London for the past 15 plus years, but I have a lot of friends and family in Greece and real estate and so on. And so I followed the crisis, the events in Cyprus, for example, and that created an interest in understanding what Bitcoin is. I started, reading a few books like Mastering Bitcoin, and started delving into Medium articles and so on. And while I was at Cambridge Associates, my previous job, I volunteered to take over the research effort on anything related to blockchain and crypto. And so I got a lot of access to funds, to entrepreneurs and so on, and kind of understood the space further and further until it became, one of my main personal and professional interests at this point.
And let's talk about how institutional investors have approached the space. And maybe, Marcus, you want to give more some background on institutional investors more broadly that might help frame the discussion on how we should think about them in the realm of crypto, investing in crypto.
Yeah. So when I say institutional investors, I generally mean, endowments and foundations, sovereign wealth funds, pension funds, maybe some large family offices. You could classify them as institutions. And I've actually observed these institutions through the beginning of their crypto investments. So if you take a step back and look at 2017, early 2018, I would say at that point they were extremely skeptical of crypto, and the allocations to crypto were, I would say, probably zero. Maybe they had some exposure to the crypto space through their venture funds, but most of them didn't even like that. Now, fast forward to 2020, things have changed a lot. And by the way, I should note here that I started covering the crypto space for Cambridge Associates back in early 2018, when it was just a curiosity, as I said at that point, and nobody was investing. But 2 years later, there have been quite a few allocations, still limited, but quite a few allocations, and small in size, but in dedicated crypto funds. So you've started seeing the institutional world entering this space and learning about this space. So I would say that it has progressed a lot over 2 years because it started from a big skepticism towards this space, and nobody was touching it.
David, how have you seen the space evolve, and how has it evolved related to expectations from when you first got into it and the opportunity you saw in front of you?
So Marcos has, I think, one of the very best kind of insights on the kind of proper institutional landscape and how they're thinking about things and what their timelines and allocation schedules might look like. My angle has been much more, I've spent a lot more time with family offices. So maybe I can speak to that, mostly in the US, also in Europe, not in Asia. And what we've sort of observed is that, 2017 and 18, there was this small kind of forward-thinking, quite entrepreneurial group of family offices that took a first plunge and sort of dipped their toe into crypto. And that happened over kind of 17, 18, and a little bit of 19. But it's a very small group, and these LPs pretty much all know each other, especially kind of the New York crowd. And then there was sort of this, there's been a little bit of a pause, and you're sort of waiting for the majority of kind of smaller family office type allocators to start dipping their toes in. And so I think over the last, 6-8 months, we were starting to see a movement of that kind of second wave, which was much larger. And then post-coronavirus, I think we'll see a big kind of bifurcation or polarization between people who are, I think, trying to move to cash and or things that are familiar to them and kind of simple and understandable, equities, bonds, back to basics. And then people that, maybe think the world is going to explode and are looking for true alternatives and true hedges. And then over in Europe, the Europeans are typically slower and more conservative. And what we were seeing, at least on the ground out of London and Switzerland, was that same group of kind of like entrepreneurial family offices making their first kind of step into the space, just, kind of 2 years behind the US. And so you were actually starting to be able to raise money in Europe for crypto strategies coming into this year. And I think that's got, another year or so to play out. And then we'll need to wait again through some kind of a trough for the next group of LPs to come in. But all bets are off as of March.
Yeah.
I just want to add here just one thing, Erik and David, that in my view, the watershed moment for institutional involvement in the space came with the first Andreessen Horowitz fund, the CNK Fund 1 back in the middle of 2018. That's when I saw kind of the first allocations from endowments and foundations and sovereign wealth funds and so on. And from there, another fund, Paradigm, a spin out of Sequoia, came to market, and that also received a lot of interest. And so those two, I think, were the catalyst for institutional flows into the space. And then since then, good news for the space is that new managers without these big brand names have managed to secure some institutional capital as well.
It's been about a year since, you released a pretty incredible report on the crypto space in January, February of 2019, I think. And I think the reception outside of the crypto community was quite muted. And then Facebook came along and did Libra. And I remember you mentioning that there'd been a real kind of uptick in interest post Libra. And I remember asking you at the time if you thought it would be that would be a watershed moment in allocation. And I wonder, a year on almost, has that kind of happened? Do you think that Libra was a turning point in how people perceived crypto, or that it sort of died down?
That's a great question. So yeah, it's true. So we wrote this paper back in February of 2019, released it then. The price of Bitcoin was around 4,000 or less at the time, and we were just out of that bear market. So when it came out outside of the crypto world, we did receive a lot of questions about it from institutions. To note here is that this report went to a lot of institutions. We did receive a lot of requests and questions, but I didn't see that many flows. And then when Libra came, when Facebook announced Libra, I think the volume of questions, requests, and presentations increased substantially. And investments did pick up since then. but not to the extent that I would have expected at the time. So I believe, David, when we had spoken back then, I told you, I think now this is the catalyst and we'll see much more.
Mm-hmm.
So we did see substantially more, I would say, but it's still very limited. It's still very limited. We can go into the reasons why it's very limited, but it's a handful of institutions investing at this point, and in kind of small check sizes, but it's growing, and it's increasingly on the agenda of various investment committees to at least review kind of the crypto landscape and the manager landscape out there. So
can you put some numbers on that? Like, how many institutions in the US do you think are actually considering this, and what would the investment amounts look like, maybe aggregated?
Oh, wow. That's it's more from anecdotal. It's more anecdotal evidence or kind of my gut feeling. So don't hold me accountable on this, but I would say there should be at least 25, 30 institutions
in the US.
In the U.S. that have been actively looking at crypto, and this includes some of the large endowments, but also some smaller endowments and smaller foundations. I would say at least 25, 30, and of which maybe half have already made allocations. The other half are kind of far into their research into the space and meeting managers and so on. So in terms of dollar amounts, they're still pretty small. So one thing to note is that even if you're a $1 billion endowment, let's say as an example, when your typical investment in a fund is, in the case of equity, it could be 5-6% of the endowment. In the case of venture capital funds, maybe, substantially smaller than that. But in the case of crypto, it's even smaller. So you can see a $1 billion endowment investing like $5 million into a crypto fund at this stage. So they're dipping their toe. So in terms of actual dollar amounts, they're not a lot at this point, but they're increasing. And as you know, it's a lot of capital out there. So it's a process. I think it will take a few years. And my theory is that if there's a use case outside of Bitcoin is kind of a killer app. You could call it a killer app. But if there's another killer app coming out of crypto in the next couple of years, I think you're going to see much more institutional capital going in.
And do you have a sense for what COVID has done to that appetite?
Another great question. And I think in general, COVID for risk assets, and I would call crypto a risk asset area. Let's exclude Bitcoin for the time being. I think from what I see, we're still early in the game, of course, of the COVID situation, and the recession and the effects are going to be evident a little later with a lag, I believe. But I think it's hurtful for fundraising and for risk assets, broadly speaking, because people will eventually want to go into anything, pretty slowly, cautiously, hoard some money. They're also getting hit on their liability side, on their operations side. So take a endowment like a university, right? They're going to be shut for a while. They might not be receiving tuition fees or other fees. So I think in that sense, it's not great, but it's not great for anything. Now, with that said, I've had a few conversations with institutional investors with respect to Bitcoin specifically as a potential hedge in this environment. So as of now, I would say it's probably a good environment for Bitcoin and probably a less good environment for the crypto space as a whole ex Bitcoin. But on the other hand, as with traditional venture, it's in these types of crises where valuations go down and then private valuations go down, and then good companies survive and are capital efficient and resilient, and then you see kind of the really good returns bouncing back from these types of situations.
David, I want to address something you said earlier about for people who think the world is gonna burn. Are most of the people who are interested in crypto right now interested in as a hedge, or is there a world in which the status quo remains and yet the crypto asset class does well too?
I think kind of both are correct. I always try and separate Bitcoin out from the rest of the crypto world. I think Bitcoin is the only crypto asset, cryptocurrency, which is basically mature, which isn't going to change, and which has found its use case. And I think that use case is sort of settled on Bitcoin as this kind of interesting hedge against monetary and fiscal irresponsibility. And 6 months ago, that was a somewhat academic exercise. But hard assets that are also transportable are actually quite rare and are now potentially quite in demand. And if you sort of stack kind of Bitcoin up against gold and break down all of the desirable characteristics of gold and do a kind of compare and contrast with Bitcoin, you'll find that it basically ticks all the same boxes, except for this kind of strong, time-tested social agreement that everybody has that gold is a store of value during difficult times. And so I wouldn't say that Bitcoin is on the same kind of par as gold and seen so strongly and through thick and thin and war and whatever you want to be the store of value. But it's, I think you can make a very strong case that it's in transition and potentially going now. And if it does, it's incredibly underowned. And so you've got this interesting asymmetry with Bitcoin that you don't have with gold. And so I sort of have this feeling that firstly, that is kind of the dominant narrative for Bitcoin. I think there are other arguments you can make around, Bitcoin being the source of collateral for, value transfers on the internet and sort of this base layer that allows you to collateralize things around the internet and enable a bunch of other crypto networks. But if you really look at kind of the core of it today, it's that kind of hard asset type hedge. And it's potentially very interesting, and it's a small market that's not very owned, and it takes not that much to move the price relative to gold. And I think, sure, if you're in an OECD country or the US in particular, and you own a stable currency and you're in a stable government and you have a relatively stable economy, then these things are relatively academic and hypothetical. But when you live in a country which is a smaller economy, which has large amounts of nominal US debt, USD denominated debt, and you don't have the luxury of just being able to print money and have fiscal deficits, I think you get sort of you catch a bid in a few of those countries. And if you do, that can really move the price. So it's like Bitcoin versus gold. I think there's there's kind of a wider variety of scenarios and outcomes in which it might do well. So I think predominantly Bitcoin is interesting as a hedge at the moment. And then the rest of crypto is, as Marcos was saying, it's high risk, it's venture, it's really early stage stuff. The token economic models of these cryptocurrencies are still changing. So you don't even know how they're going to accrue value 5 years from now. So it's very early stage stuff, very interesting, but I think that stuff firmly goes in the venture bucket, and Bitcoin basically goes in your macro bucket with, a little bit of it going in kind of the venture bucket as well.
And you were talking a bit about COVID, but talk more about, some people are confused about how to think about Bitcoin through COVID, through the sort of the Fed, printing trillions of dollars, and how it's responded. How should we make sense of how Bitcoin has acted and what that means for it?
So we specialize in market neutral and therefore kind of trading. And Bitcoin had this huge crash on in the days leading up to March the 12th, and then specifically on March the 12th. It dropped about 50% peak to trough, very, very fast, then rebounded and has sort of been kind of creeping back up since then. But Bitcoin dropped to, you had liquidations at about $3,300 on BitMEX. From what we've been able to untangle from that, it was very much a kind of liquidity-driven crash. You had a broader market that was selling off. People wanted to take risk off. And when you have a lot of leverage in the system, as we did, we had a lot of people basically going and buying derivative contracts, perpetuals, futures, etc., with large amounts of leverage. And the majority of platforms on which they're trading these, the collateral that you post to get that leverage is Bitcoin. And so you're buying Bitcoin with leverage and using Bitcoin as collateral. And so what happens as the price of that contract or derivative drops, you need to post more collateral. But because your collateral is denominated in Bitcoin and the actual value of that Bitcoin itself is also going down, you get this kind of exponential requirement in funding. And so you had this scramble for Bitcoin, and people couldn't post enough collateral quickly enough. And so the whole thing sort of blew up. You had this massive blow up in the market. But that pricing on Bitcoin and the way in which it crashed is not representative of what the spot markets were doing for physical Bitcoin, which basically didn't move that much outside of arbitrage activity. And so on the one side, you've got kind of like a lot of speculation and leverage and trading, and it went up, then it blew up, and then it recovered. And on the other, you've got kind of the people that are actually holding this because they get some utility from it, or they're holding it as a hedge. And if you look at, different statistics, on-chain statistics, looking at, were the big Bitcoin owners selling, were the old Bitcoin owners selling? So you look at like statistics like days destroyed, you can't see kind of a big pattern in mass selling by the big holders of this or the long-term holders. So this seems to have been really kind of a trading phenomenon rather than anything else. And I think, an economy kind of crashes, goes into recession pretty quickly. Stock markets crash. It's normal for assets to all correlate and all go down at the same time. This is what we see in any market panic. And Bitcoin was certainly part of that. But the kind of longer term thesis around it, I think, only got stronger. And I think when I look and speak to people in the crypto space and look at what's happening, it weirdly seems like everything is pretty much normal and has been since February. People are raising, companies are still moving forwards. There aren't mass layoffs because this space is so distributed and so engineering heavy. Basically, everybody can work from home, and the conferences just happen online, and the world moves on in crypto. And so COVID doesn't seem to have had much of an impact so far. I think it will have an impact on allocations, but there's sort of enough money locked up in venture funds that if you're a really high quality project or company in this space, you can get funding.
Yeah, I want to add something here to David's points. These are great points on Bitcoin, first of all. Let's put it into perspective. David, I think, analyzed the drawdown in Bitcoin, really effectively in February, I believe it was, March.
It was March.
But since then, if you look at the numbers, and of course, Bitcoin, like other assets, but particularly Bitcoin, because it's so volatile, is very beginning and end sensitive. But as of right now, Bitcoin is up 25+%, and gold is up like 12-13%, and then markets are down 15%. And if you look at these small caps, they're down 25%. So I would say that as of now, Bitcoin has done really well in this environment. So the other thing I want to note is that I saw some a posting on Twitter from various people that I found interesting. You have quantitative easing in the world right now, and then you have quantitative tightening in Bitcoin, with a halving. So I think its role as a hard asset in an environment of zero interest rates and unprecedented money printing in the next few months could be evident, I think, its role as a hedge. And then on the comments that David made with respect to crypto and teams being distributed and so on, I think that's a great point as well. A lot of these projects have been functioning pretty well in this environment, unlike some particularly physical types of businesses.
Well, why don't we talk about the different fund strategies in crypto and some of the pros and cons there?
Yeah,
Marcos, do you want to chat about VC?
Yeah, sure. I mean, I can start with VC, and I'll let you talk about the quant stuff, because you know the quant stuff really well, and I think you've done some of the best research there. So, just to set the stage here, I think it's one of these unique areas where there are many types of strategies, and they come on one end of the spectrum. You have the ability to invest directly, like you invest in Bitcoin or Ether or other crypto assets directly, to index funds, to hedge funds, and all the way to venture capital. And that all these strategies are quite different, but there's also a lot of overlap. I think the space is very new. And so, for example, you might see hedge funds that own both equity and tokens and Bitcoin, and then you will see venture funds that own all of the above as well. So far in the institutional world, I think it's the venture type of structures that have been the most popular. And I generally favor the venture structures for reasons that I can explain at this stage. Even when it relates to holding some tokens and Bitcoin and so on. But then, of course, on the hedge fund side, there are some more trading-oriented strategies that would not make sense to have in a venture structure. But again, from an institutional perspective, I think venture structures are by far the ones that people have favored so far. And if you ask me the reasons why, I mean, it's simple. I think most institutions view this as a subset of venture capital, view this space as a subset of venture capital, even including Bitcoin, I would say. And it is in many ways a subset of venture capital. And therefore, a lot of the people researching this space for these institutions are venture capital people. So they have a tendency to favor the venture structures in the first place. On the other hand, because this space is so volatile, so fast moving, having a venture structure, I think, helps in many ways the manager. It helps because one can average into the space over time, and that seems like a good idea in this space, given how things evolve and change. One can draw capital, when there's a crisis. For example, I saw some venture funds venture structures, crypto venture structures, back in 2018 when there was selling everywhere. They were actually drawing capital to buy Bitcoin, and now they've bounced back really aggressively, and they have really strong returns as a result. So the ability to draw capital, play offense, when at the worst possible time in terms of prices is a great benefit. There's less business risk because you know how much you have in commitments and how much you're going to get paid over time. And then the carry is paid at the end of it all. So for these reasons, I've generally favored venture types of structures. And by that, I mean, not necessarily equity. I mean, teams that play the entire crypto spectrum from equity all the way to Bitcoin. Now, the quant side, David, is a totally different animal here.
So I think on the venture side, you're really kind of making kind of deep, fundamental, long-term technology bets. And on the quant side of things, it's totally different. And what you're really doing there is trading what we call market structure. You've got, as we see it, there's sort of like three main buckets of quant strategies. The first one is arbitrage. And there are features in this market that are quite unique. It's extremely volatile and it's extremely fragmented. And quite uniquely, you in our market in crypto, you have Bitcoin that trades against the US dollar, the euro, pound, the Polish zloty, et cetera, across a ton of different kind of liquidity venues. So basically, every country has like 1, 2, or 5 or 10 competing crypto exchanges. All of them trade Bitcoin. So if you zoom out and look at it globally, you've got over 100 liquid crypto exchanges that are all trading Bitcoin, and they will trade those typically against fiat, amongst other things. And so you have these situations where people wake up in Poland, and they see some news that happened in China. So, for example, I think it was like mid-October, the Chinese premier kind of stood up and sort of announced to the world that blockchain was going to be a strategic priority for China, and they removed Bitcoin mining from the list of banned activities. And Bitcoin shot up like 40%. If you were asleep in Poland or Germany or New York when that happened, you probably didn't react to it. But if it was a Friday afternoon in China, everybody probably pulled out their phone and traded that news. And so you get these kind of dislocations in price where the price can move quite suddenly for some reason, but different exchanges will respond to that information in different ways and with time lags. And so it's very easy for you to kind of buy Bitcoin high over here and sell it even higher over there when the price is shooting up, or vice versa. And so you get these kind of very, very simple arbitrages in in the spot market. So just, standard Bitcoin for fiat. But then there's crypto to crypto arbitrages. You have three legs. So, arbitraging like USD to Bitcoin to euro and back to dollar. Then you have all of these kind of derivatives in the space. And, you have perpetuals and futures and quantos and options. And all of these kind of are related in mathematical ways to each other. And they trade with, typically a lot of leverage and even more volatility than the spot market. And so you get all of these dislocations across this market. And you can basically transpose well-known arbitrage strategies from traditional markets, equities, FX, commodities. And you can just kind of like copy paste them into the crypto space with great effect. And so you have like in quant, this first bucket around arbitrage, a second bucket around like what we call liquidity provision or market making, providing liquidity to people who want to trade big blocks or bringing liquidity to different exchanges or across different pairs. You can basically think of it like a toll booth. You make a little bit of money every day to provide that liquidity. You basically get paid for it. And then the third bucket is what we call statistical strategies. So if we focus in on Bitcoin, but this applies to everything else, we don't have robust fundamental valuation models for this. So these currencies will trade on kind of technicals. And so you'll see things like trend working really, really well in markets like this. These things go up and they just keep going up, and they go down and they keep going down. And so trend following strategies, especially longer term ones, can work extremely well. And then you've got equivalents to kind of statistical arbitrage and mean reversion and a bunch of other stuff in this market. And so the quant space is really has professionalized an enormous amount since we started specializing in it about 2 years ago. And what you're typically seeing is basically like it's traders and hedge funds with backgrounds in trading in traditional markets, typically the kind of Chicago prop shop scene, your Jane Street Capitals and your QSRs, Susquehanna, Wolverine, etc. People leaving there where they were trading futures, very profitably, and moving into crypto, which is less efficient and more volatile, and just making a killing there. And so it's this interesting place where I think there's a lot of opportunity because of the volatility and because of the fragmentation. And you have people that are just trading that, but it's certainly more zero sum than the VC side of things. And then finally, you've got, we've been spending a lot of time on what we call special situations. The crypto space is getting more and more kind of large and more complex. And you have kind of special situations popping up all over the place in credit, in kind of, secured credit, trade financing, litigation financing, bankruptcy claims, liquidations. There's all sorts of kind of fun stuff hanging around this place. And the crypto guys don't want to touch it because it might outperform Bitcoin. And they kind of all think that, Bitcoin's going to moon. And why would I take the risk on this other investment when I might not make as much money as buying Bitcoin? And then the guys from outside of crypto, to them, they don't want to touch the space because it's all kind of drug money and tulip bubbles. And so you come to them with, a simple bankruptcy claim that they can buy for less than the cash in it, with a free option on Bitcoin on top, for example, and they'll just like kick you out the room. I've never seen anything with more alpha in this space if people are willing to either bite the bullet on crypto and say, I'm actually going to do the work to get comfortable with it, or bite the bullet on saying, maybe there is some world in which Bitcoin doesn't get to $1 million and maybe I could do one other trade. And so it's a very interesting space, and there's tons of stuff in it. But the main things are kind of like the VC bucket, the quant bucket. And then other than that, it's stuff, at the fringes you need to kind of sniff around for.
I totally agree with you, by the way, David, that there's a ton of interesting stuff in special situations, quantitative strategies, and so on. I think one of the reasons, aside from the reasons you mentioned, people not trusting crypto and so on, but one of the reasons why institutions haven't put money into the space yet is, I think, scalability, right? In a lot of these strategies, these quant strategies can work wonders. They can give you 50, 60% types of returns, but they can only be, $10 million or something in order to be able to succeed that. And that kind of goes to the second point I wanted to make here with respect to these strategies, that they're beautiful in terms of their alpha potential, but because they're not scalable, a lot of the very talented people in the quant space haven't navigated towards them because they're making much more money in much less efficient areas, but where they can deploy tons more capital. So, but that said, you've started seeing, I think, some really experienced investors leaving the traditional macro world and hedge fund world and going into it.
So interestingly, Renaissance Technologies, who run the Medallion, basically the most profitable and successful quant fund in the world, recently filed with the SEC to say that they want to kind of add Bitcoin futures to their quiver and start trading those. So it'll be interesting to see how that impacts the market, if at all, over the next few months.
Yeah, absolutely. And you have the halving at the same time. I think without predicting anything, because we have no idea where the price is going to go, with the halvening and the substantial reduction in supply, if more institutional capital of this sort starts coming into the space, you have potentially, a very good backdrop for a rising price.
We'll see.
How should we think about generalist VCs versus specialized approaches here in the crypto landscape? David, do you want to take it?
We've been releasing a series of Medium articles on how to think about venture in crypto as an allocator. And we've literally been writing kind of the piece on Edge over the past few weeks. I imagine it'll be out by the time this goes live. But generalist VCs have totally failed to make good investments in this space on the whole. And what happened? I think firstly, their brand had zero halo effect in this market. They weren't attracting the same kind of flow, which I think they'd taken as a given, because crypto is really its own community with its own origins. It's very different to, marketplace investing. And then the guys at these generalist VCs were dedicating 10% of their time and brainpower to this. This was one of many things that they were doing. And the problem with crypto is it's extremely complex and dense and fast moving. And you just can't keep up unless you're spending all of your time in it. And then they kind of delegated crypto to kind of a single analyst or principal who probably had to beg to do it. And then they had to go and educate themselves. They had to go and network and build that network from scratch, get flow. Then they had to educate upwards to their partners if they actually managed to find something good. And half the time it just gets killed at the investment committee level because there hasn't been enough education for an interesting crypto deal that isn't plain vanilla to get done. And so what happens is that after a few of those deals, that analyst or principal just gets frustrated and leaves and sets up their own shop. And so you've had this outflow of talent interested in crypto from the generalist VCs. And I think A16Z is really the only shop that managed to kind of buck that trend. And they set up a dedicated crypto fund within their franchise, A16Z Crypto. But, the crypto deals that I've seen done by the big guys have just stunk of defensiveness. It's like some partner realized that they really needed to index the space just in case crypto was as big as some people were saying. And so they did it with some hygienic deal, something that could get through an investment committee that LPs wouldn't kill them for. And so they did things, major, Series D, E, or whatever in very large exchanges, or, I think the Kick ICO was one of those kind of hygienic deals that you could do without getting fired. That was a terrible and overvalued investment. That's a zero, essentially. The Telegram ICO was another one of those. So you had these kind of small crop of hygienic deals that they did, and that was kind of it. And I think there's been a real white space for people to come and do early stage and late stage venture as specialized crypto investors. And Marcos, you've done lots of work on VC. What do you think?
Yeah. No, I think you mentioned some great thoughts here, and I'll add to a couple of them and offer a few more. So I'll start by saying, again, I'm adopting the institutional perspective because I think it's interesting, and that's kind of what I've been observing all these years. I received the following question constantly from investors when we were discussing crypto. They were saying, and they still do, they were saying, we have all these generalist VC funds. and they can invest in crypto, and they can time it much better than we can. They can allocate to the best deals and so on. So why on earth do we need dedicated crypto funds? You described, I think, very elegantly the structural reasons why in a generalist VC firm, very hard to do crypto. I just wanted to add also, a couple more points on that I share with institutional investors. It's a very idiosyncratic space, as we said. There are tokens, early liquidity, it's open source. There's things like network participation, mining, staking. So we can all agree it's a very different animal from traditional venture. Very different animal. So just as a very simple example of a structural issue a generalist VC fund has is their LPs have not signed up for doing these sort of things. So they have LP constraints, LPA constraints. They have partners who don't, as you said, David, who are not familiar with the space. And if it's a consensus-driven type of investment committee setting, you probably won't get the best ideas through it. Also, some of the senior partners there have a ton of money on their hand. Last I checked, there's about $250 billion in dry powder in VC, and there are plenty of Web2 business models that are doing well and entering, parts of the economy. So they don't even have an incentive to let go of what they've been doing for all this time. So, so in short, in summary, the answer is no, you can't do it through the generalist VCs. Maybe you can in certain occasions, but at this stage, it's not a good idea. I think you should try this space through dedicated crypto funds where they can play their game unconstrained. The other thing that you mentioned about generalist VCs, and I came to mind, you mentioned, David, that some of them did, invest because they thought, what if this space grows very large and I don't want to miss out. So it's very interesting to note here that in 2017, I believe there were way more generalist VCs doing crypto than they are now. I think now they've pulled out of it almost completely in many cases. And the paradox of this, which points to the fact that they're not the best way to invest in crypto, it's a data point, is that they were investing in crypto when prices were sky high. We can all agree it was a huge bubble in 2007. Mm-hmm. They were investing in crypto then when prices were sky high and when fundamental developments in the space were way behind where they are now. But they think that the space is not worth investing now at much lower prices and with much more traction and more fundamental developments. So I think that's noteworthy. They have pulled out. And I think back in 2017, they probably didn't want to miss. It was the FOMO effect. They didn't want to miss potentially exploding prices. So in short, they didn't really time it right, did they? If the argument was that they would time it right, they didn't.
It's easy to say in hindsight, there's a world in which it could have gone the other way. But I think certainly if they were going to make an investment, they should have been bought into this as a vertical enough to continue doing the work after the boom. And by and large, they haven't. And I think that's a real shame.
I agree. Listen, I mean, the prices could have gone up further and they were playing a momentum game at the time. But the fact is, the very simple fact is that you had higher prices, much less fundamental traction or progress. And now you have much lower prices, much more fundamental traction and progress, and they're not here. So I think it was purely at the time, again, that fear of missing out. And I don't blame them for it. I'm just stating facts, I think, here.
The structural challenges for a generalist VC to operate effectively in crypto are really high. Like you need to rewrite the LP mandate. In Europe, half the funds have public money, which is to say that like the state is an LP. And obviously that comes with a lot of strings attached, but among those, very restrictive LP agreements in which they can't just go off and do crypto or buy a liquid asset or, even invest more than a certain portion of their fund into projects or companies which aren't based in France or the UK or Germany, depending on whose money they took. Because the public money in Europe is trying to kind of foster entrepreneurship and create kind of large tech businesses in their own countries. And so you have a huge kind of clash of incentives. And the incentive isn't there because the market is still too small. But I think that leaves this wonderful opportunity for focused small funds who are able to write liberal LP agreements that let them kind of move to where the puck is, to over the 4-year investment period be flexible about where the right investments are. And it's sort of I think you can sort of compare crypto investing to crypto venture is to like traditional venture what like hedge funds are to mutual funds. So mutual funds are these like lovely kind of regulated quaint funds that can only do basically one thing. They can buy stocks or they can hold cash. And that's it. Hedge funds sort of come along and they say, well, we can do basically like capital structure arbitrage. Like we can look at going long stocks, but we can also short stocks. We can do pair trades. We can use leverage. We can use options. We can buy debt, mezzanine, secured, unsecured, whatever, preferred shares, all of this stuff. A hedge fund ultimately has a lot more kind of quivers that it can use to express an investment thesis. And that's sort of what the good crypto funds look like today. They're able to look at the crypto ecosystem, figure out where value is going to get captured, how it'll be accrued, what's the best instrument to access that, and go and do it. Whereas your sort of traditional venture vehicles, they can't do liquid tokens, they can't do this, they can't do that. They're very, very constrained in what they can do. And so it's almost kind of this, we think this kind of structural unfair advantage to the smaller players, the smaller kind of crypto-focused funds, not just in their ability to source and analyze deals better because they're more focused, but because they have the structural advantages, which are huge. And then finally, because they're smaller. And this is an early stage market, and you need to be able to make seed bets and have those move the needle. So there's a bunch of stuff, I think, as to why this space in particular, I think, is wonderfully suited to specialized managers.
David, why don't you talk a bit about investment opportunities right now?
Yeah, sure. So one of our biggest observations over the past couple of years has just been that the space moves really fast. And as a corollary to that, alpha and opportunity also degrades fast. And kind of the big thing there is you need to be nimble. Trades get crowded really quickly. So, we think that there's enormous benefits to really understanding this market inside out and being able to see everything and pick the interesting kind of uncrowded places to go and play. And a lot of the interesting stuff that we see right now is actually on the fringes. It's capacity constrained quant and special situations. There's DeFi stuff, tons of interesting kind of uncharted waters there to go and explore. Liquidations, bankruptcies, other, more traditional special situations. I think that we've got a lot of those coming down the pike, a lot of kind of failed projects from the ICOs and a lot of miners that may be in distress 6 months from now. And on the venture side, my feeling is we're in a little bit of a quiet period, which is probably the right time to go out and raise a fund and have 4 years to go and deploy that capital, because I think it won't be too long before we see a resurgence in sort of, the next version of what crypto looks like.
Should institutional investors be allocating to crypto and how much or in what capacity? How should they think about it?
That's another great question. I think, crypto is a very early stage venture. I think David called it very early stage venture, and it is. It's a new space. It's still working through its infrastructure phase, I would say. You haven't seen the killer apps outside of Bitcoin. The killer apps are probably 2-3 years out or more. But in that sense, it's because it's very early and because it's very risky and because it should be viewed kind of as a riskier subset of venture, in my view, the allocation should be a small subset of venture. Now what does that translate to? I think, when we wrote our paper about a year and a half ago, we said not more than 1%. And of course, this kind of arbitrary in a way, but I would say that if people do their homework, understand what they're getting in, and view this space as a potential call option with potentially very high payoffs, but also very high risk, by putting, like a percentage point in, or maybe a little less, they risk very little capital, but they could see, multiples of that in the event that this space does fulfill its promises. And I think the way to play it would be to invest across vintages, keep on investing, and keep on having kind of your allocations around where you target them. And as it matures, maybe start, gradually increasing your allocation. So in summary, I'd say, for institutions, I wouldn't put more than 1%.
Totally. That sounds like a great place to wrap. David and Marco, thank you so much for coming on the podcast. It's been a great episode.
Pleasure. Thanks a lot, Erik.
Thank you, Erik.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.